We now know that on an average about 8% of EPS upgrades are in order for corporate India. But can you give us some more nuances? Do you think they will use all of it now? Or do you think companies are likely to, reduce their EBITDA itself by increasing expenses so that, they can use that profit already in capex or upgradation?
I think this is the big debate on whether the saving is going to go towards capex, which is what the government would have wanted to happen, or will it in some form and shape be passed on to the consumer. Either way, there is a positive. I mean, if the saving is passed on to the consumer in some form and shape, then, we've all been talking about how muted the demand has been over the last many months. We can see that in the numbers that come quarter after quarter, Lata. And should that happen, then hopefully it provides some impetus to a benign demand situation. And that's not bad at this point of time. We do have significant capacity underutilization at this point of time. And if demand can go up, then hopefully that capacity can get further filled up. The other, of course, option, which I think was government's great desire, was to see that at least the saving goes into new capex. My own sense is that it'll be a divided house. New companies, particularly global companies that were otherwise investing in China and that are looking at new opportunities to invest. These opportunities, as a result of the regulatory changes in China, were all relocating to other Asian countries. And I think government is trying to seize that opportunity to see whether these new investments can actually relocate to India. So in that sense, lower tax rate, a more friendly tax regime will positively impact the decision of these foreign companies to relocate their production in China, which is great from an investment perspective, employment perspective. On the other hand, I would like to believe that existing companies, large companies in India, that have underutilized capacity are unlikely to make further capex at this point of time. But even if they pass on that benefit to the consumer in one form or shape, I think it will help the demand side. So either way, it is a plus, I would say, at this point of time.
Ashok, hi, good morning. The other point that I want to discuss with you, and if you have any empirical evidence of that, one is this tax cut, which is obviously going to lead to EPS increase. Do you see the multiples also of the stock market improving? And in that sense, not having only a 10 to 12% impact, but a higher impact, multiple and re-rate, the EPS and multiple re-rating both getting impacted.
We've all discussed on whether Indian markets are expensive or not expensive. I would like to believe that even after some of the correction that took place, Indian markets were not necessarily cheap as you compare them to other emerging markets, for sure. And therefore, to expect that this increase in EPS is also going to result in a re-rating, at the margin, yes. Because when the sentiment improves, it obviously rates the multiples, re-rates the multiples. But beyond the margin, I'm not sure, because it's not as if the market was cheap, and therefore this cut in taxes and therefore improvement in EPS will naturally result in a re-rating.
Broader market was cheap, right?
Yeah.
Perhaps not at the index level.
Yes, no, so I would agree with you. Whether it is at the index level or whether it is even at specific corporate level, it's not as if, we have seen a serious divergence in this market over the last 6 months, where what we call good and clean companies have really been allocated a very large part of the new investment that's come into the market. And I'd like to believe that it's unlikely that those companies will get re-rated any further. But companies that have not received much allocation from the funds, perhaps possible that this change will invite more investment in those companies. And the re-rating of those companies that have remained relatively benign in their growth in the market cap over the last 6-12 months, perhaps they will receive more allocations, and that demand could result in some re-rating of those multiples, for sure.
Ashok, hi, good morning. Coming back to your earlier point then, the government is clearly trying to reduce the hurdles for an entry into India in terms of manufacturing, etc. You spoke about the, the incentivizing new units at about 17% tax, but there are still some other hurdles, right? Whether it's stringent labor laws, delays in land acquisition, etc. If the government has to take another step forward to sort of cure some of those issues, what do you think the need of the hour is now? And are you expecting anything at all?
So my own sense is that this finance minister has shown an outstanding understanding and appetite to slowly but surely move the economy in the right direction. If you saw the early announcements that were made by the government, they looked a little less eventful in terms of making major impact either on the growth or indeed on the market sentiment at this point of time. But this one has really demonstrated that there is keen desire to do whatever it takes to get the economy back in a positive mode. And improvement of sentiment is a very important part of that change. So I think this is a really big change that she has made. I don't think that they will stop at this. My own sense is that the government is now keen to see that this flows through both on the investment side as well as, of course, on the demand side. There is a big debate, as you know, which goes on in the marketplace on whether this 145,000 crores was better spent by reducing the GST rates versus reducing the corporate rates, because one would have propped up demand versus having propped up the investment cycle. But I do think the government has concluded that there is a lot of global capital that is keen to invest in India. And to that extent, I think this government has done a remarkable job of creating a huge positive motivation amongst large global companies and global funds. We've seen how large pension and insurance companies have been investing in the infra segment thanks to government's policies. If that can be followed suit in the manufacturing side, then I certainly think there's a lot of, there's good reason to believe that there could be relocation of factories to India.
Okay, would you say that net, you're betting more on foreign capital than domestic capital?
You know, at this point of time, I would unfortunately say yes. One would like to see more domestic private capital be invested in India, and one would like to see more domestic capacity being expanded. But I would like to believe that this move, and certainly everything else that has happened, augurs very well for global capital to come to India. Whether domestic capital will also accept this invitation, I'd like to wait and watch, because as I said, there is excessive capacity at this point of time in domestic industry.
So would you say that also that the leeway for higher production will actually come from tapping foreign markets, not just capital, but even foreign consumption, because there is no fillip for domestic consumption?
Yeah, I would tend to agree with you. I think government now seems to be seeing India in that sense in a little borderless manner and saying, why do we have to just focus on domestic consumption? So long as, because remember, the key focus has always been how do we create more employment? And without doubt, if you are able to invite global capital to manufacture in India and then use that capacity for exports, I think it's a win-win across board. And I think that could actually deliver the most critical piece of where government's focus is, which is creating new employment opportunities.
Okay, one final question then. From a market standpoint, you know, every budget we discuss the fiscal deficit number and whether it will be breached. This time around, as we know, the government has chosen to put fiscal prudence on the side and focus more on pump priming growth. Someone was telling us 3.8% is the expectation in terms of fiscal slippage. What's your own view, and do you think the market will get ruffled by it at all, or is it more looking towards growth?
I believe the market is not going to get ruffled by a little increase in fiscal deficit. Right now, the market expects and wants the government to focus on growth versus pure fiscal deficit. You know, on the parting note, I wish the government had accepted one more suggestion, which is, I think, very critical. I wish the government had introduced one more tax legislation which says that any purchase of primary property, real estate, any loan taken for purchase of primary property, 100% of the interest paid on that would be deductible for the next 5 years.
And I can solve the real estate problem.
I can tell you that would have provided a serious incentive for both salary taxpayers as well as others. You know, believe it or not, we are a tax-focused nation, whether it is on the collection side or on the saving side. And if we could have tapped that sentiment and brought in a legislation to say any interest that you pay for purchase of primary property for the next 5 years would have resulted in a natural demand for purchase of new properties, that would have allowed the real estate developers to offload their excessive...
But you can't take loans to buy real estate from banks. You can only buy homes. No, you can't buy land.
No, I'm not talking about land.
Okay, you're buying
I'm talking about homes. I'm talking about primary purchase of property, meaning primary purchase of housing. And because that's what the developers would have been able to offload. That would have given them the liquidity. They would have then repaid and serviced both mutual funds as well as banks and NBFCs. And I tell you, I personally believe that that would have added a little more to the fiscal
We hope the
deficit.
finance minister is listening to you.
Sonia
at some
asked
point.
you that question, what more should they do? And we have this big answer from you.